In financial planning, I often get to walk alongside my clients as they dream about the good parts of life: travel, retirement milestones, generous gifting. But there's another conversation that always comes up. Sometimes clients raise it themselves, and other times I am the one who gently prompts it. What happens in the later years of life, and what is our plan for that? My name is Brenna Baucum. I'm with Collective Wealth Planning, and that question is at the heart of long-term care planning. Long-term care is one of the biggest unknowns in retirement. Some people never need it. Others need years of support. Costs can vary widely depending on where you live and the type of care that you need. And like most decisions that involve money, it's not just financial, it's also deeply personal. So when we say long-term care, we're usually talking about the ongoing help that people might need with everyday activities, like bathing, dressing, eating, mobility, or supervision due to cognitive decline. You might have heard of these as ADLs, or activities of daily living. And one quick misconception I'd like to clear up: Medicare typically does not cover ongoing custodial care like this. It may cover some limited skilled nursing care in specific situations, but long-term help with daily living is a different category. The goal of long-term care planning isn't to predict exactly what's going to happen. It's to make sure that your financial plan can bend without breaking if, and in most cases when, care becomes a part of your story. Broadly speaking, there are 3 ways that people tend to pay for long-term care. Some self-fund using income, investments, or home equity. Some use insurance to transfer part of that risk, and others rely on Medicaid once assets are depleted and eligibility rules are met. In reality, most people end up with a combination of these, intentionally or otherwise. So when people think about long-term care insurance, they often imagine one type of policy, but there are now several structures in place. This field has really evolved quite a bit over the last 15 or 20 years. Traditional long-term care insurance is designed specifically to help cover care costs, and it can be a good fit for people whose priority is protecting a spouse from a financially draining care event or preserving the flexibility to meet other goals. And when you're evaluating a policy like this, there are a few key moving parts that really matter: the daily or monthly benefit amount, how long benefits last, and the elimination period, meaning how long you pay out of pocket before benefits begin, and whether there is inflation protection. That last one is a big one. Hybrid policies combine life insurance with a long-term care benefit, and they can appeal to people who don't really like the idea of paying premiums into something that they may never use. If care isn't needed, there's typically still a benefit that goes to the family. Life insurance with a long-term care rider sometimes makes sense for younger individuals who still need life insurance, but want the flexibility of care that is maybe later needed. And annuities with long-term care riders are sometimes used to reposition existing assets, particularly if underwriting is a concern, meaning your health maybe is an issue for being able to qualify for insurance coverage. So none of those options is universally the best one, right? They're all tools, and the right fit depends on your health, your goals, and your personal preferences. Some people self-fund long-term care, but that decision only works if the plan has been stress tested. So what do I mean by stress tested? It means we intentionally model what-if scenarios before you're in the middle of a crisis. Always the best time to do planning. So for example, what happens if one spouse needs 3-5 years of care and the other one needs care earlier than expected? Or what if the costs come in higher than the average for your region? I recently worked with a couple who felt pretty confident because they had a solid nest egg. And once we brought together all of their assets, liabilities, income, expenses, we could see that they had a healthy investment pool. It was enough to cover their goals and even a couple of years of in-home care. But as our discovery process continued, I learned that they had a history of cognitive decline on both sides of their family. And when we modeled a longer multi-year care scenario, the plan still technically worked, but their margin at the end really disappeared. And that didn't force this couple into an insurance decision. It instead led them to clearer boundaries around spending, gifting, and housing decisions today. So that stress test, it didn't create fear in them, it created clarity for them. I am of the belief that long-term care planning, like all financial planning, should start with questions. What are you trying to protect? How much uncertainty can you live with? And how would care costs change your lifestyle or your legacy goals? Once those questions are answered and are clear, the right long-term care strategy, whether that's insurance, self-funding, or some combination, usually becomes a lot easier to see. Good financial planning, it absolutely makes room for the exciting parts of life. But resilient planning, it also acknowledges this inevitable part that we all are going to face around aging, health changes, and the possibility that we are going to need that help later in our lives. Long-term care planning, it's not about pessimism. It's about stewardship of your resources, your independence, and the people who care about you. If you want a companion resource, I have linked to my long-term care planning blog and the downloadable guide that we have just down below. And if this is on your mind, don't guess, right? Model it, stress test it, talk it through. And if you want a thought partner to help you envision that plan, I'm here to help. Thanks for watching.